Preparing for a Deloitte M&A, strategy, risk and transactions interview. You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why are you interested in Deloitte's M&A and strategy, risk and transactions practice? I am attracted to Deloitte because the work combines strategic thinking with transaction execution and risk analysis. A client may need to decide whether to acquire a business, quantify synergies, assess operational risks, and integrate the target successfully. That breadth suits me because I enjoy turning imperfect information into structured recommendations. Deloitte's multidisciplinary platform is especially appealing. It allows teams to connect commercial strategy, finance, operations, technology, and implementation rather than treating a transaction as only a valuation exercise. While answering, focus on Deloitte's combination of strategy, financial analysis, diligence, risk management, and execution. Connect your motivation to solving complex client problems, collaborating across disciplines, and delivering practical recommendations rather than generic enthusiasm. Question 2. Walk me through the typical M&A transaction process. I would divide the process into 4 stages. First, the buyer defines its strategic objective and screens targets. Second, it evaluates valuation, financing, synergies, and performs commercial, financial, tax, legal, operational, and technology diligence. Third, the parties negotiate price, terms, and transaction protections before signing. Finally, regulatory approvals and closing occur, followed by integration and synergy tracking. The process is iterative. Diligence findings can change valuation, structure, risk allocation, or even whether the buyer proceeds. Make sure to cover strategy and target screening, valuation, financing, due diligence, negotiation, signing, regulatory approval, closing, and integration. Explain how risks and findings influence the decision at each stage. Question 3. How would you assess whether an acquisition makes strategic sense? I would test whether the target advances a clearly defined strategic objective, such as entering a market, adding capabilities, or improving distribution. Then I would examine market growth, competitive dynamics, customer overlap, differentiation, and the buyer's ability to capture synergies. I would also challenge execution assumptions. Culture, systems, regulation, and management capacity can destroy value. Finally, I would compare the expected risk-adjusted returns with alternative uses of capital, because strategic appeal alone does not justify any price. In your answer, talk about strategic fit, market attractiveness, capabilities, customer overlap, competitive response, value creation, execution feasibility, and downside risks. Distinguish a compelling rationale from simply buying growth. Question 4. What are the most important components of an M&A valuation? I would triangulate value using trading comparables, precedent transactions, and a discounted cash flow analysis. Trading multiples provide a market reference, precedents capture control premiums and transaction conditions, and the DCF tests intrinsic value through operating assumptions. I would value the target standalone first, then separately assess realistic synergies and their sharing through the purchase price. Finally, I would run sensitivities for growth, margins, discount rates, leverage, and execution risk before recommending a valuation range. Be sure to mention standalone value, comparable companies, precedent transactions, DCF assumptions, synergies, financing effects, control premium, market conditions, and downside sensitivity. Emphasize triangulation rather than relying on one methodology. Question 5. How do you build a DCF valuation for an acquisition target? I would project revenue, margins, taxes, capital expenditures, and working capital to calculate unlevered free cash flow. I would discount those cash flows using a WACC reflecting the target's operating risk and appropriate capital structure, then calculate terminal value using either a perpetuity growth rate or exit multiple. After discounting, I would adjust enterprise value for debt, cash, and other claims to reach equity value. I would keep buyer-specific synergies separate so standalone value remains transparent. Focus on forecasting unlevered free cash flow, selecting a discount rate, calculating terminal value, discounting cash flows, adjusting for debt and cash, and testing assumptions. Explain how acquisition-specific synergies should be handled separately. Question 6. What is accretion and dilution analysis, and why does it matter? Accretion and dilution analysis compares the buyer's standalone earnings per share with pro forma EPS after the transaction. I would model the target's earnings, financing costs, new shares issued, purchase accounting effects, taxes, and achievable synergies. If pro forma EPS exceeds standalone EPS, the deal is accretive, otherwise, it is dilutive. However, I would not treat accretion as proof of value creation. A transaction can be accretive through cheap debt or aggressive assumptions while producing inadequate returns. While answering, explain pro forma earnings per share, purchase accounting, financing mix, synergies, share issuance, and timing. Note that accretion does not automatically mean value creation, because earnings can increase despite a poor return. Question 7. How would you identify and quantify synergies in an acquisition? I would begin with the operating model, identifying procurement savings, duplicated functions, facility consolidation, technology efficiencies, cross-selling, and pricing opportunities. Each synergy should have an owner, implementation timeline, required investment, and supporting evidence. I would distinguish recurring benefits from one-time costs and probability weight the less certain opportunities. I would also test customer and employee reactions, because revenue synergies are often harder to realize. The final model should show gross benefits, costs, timing, and sensitivity. Make sure to cover revenue and cost synergies, timing, one-time implementation costs, ownership, probability weighting, overlap risks, and accountability. Separate evidence-based synergies from optimistic management assumptions. Question 8. What is quality of earnings, and what would you investigate during financial due diligence? Quality of earnings assesses whether reported profit reflects sustainable, cash-generating performance. I would examine revenue recognition, customer concentration, churn, backlog, gross margins, unusual expenses, owner-related items, acquisitions, seasonality, and accounting policy differences. I would reconcile EBITDA to cash flow and normalize one-time or non-operating items, while challenging management's forecast assumptions. The conclusions can affect purchase price, debt capacity, earn-outs, representations, or the decision to proceed. Strong earnings quality increases confidence. Weak quality requires protection or repricing. In your answer, talk about recurring revenue, normalization adjustments, customer concentration, margins, working capital, accounting policies, cash conversion, non-recurring items, and forecasting quality. Explain how findings affect valuation and deal terms. Question 9. How would you evaluate working capital in a transaction? I would analyze historical working capital by month to understand seasonality, growth, and unusual movements. Then I would separate operating balances from debt-like or non-recurring items and calculate a normalized level required to run the business. That level typically becomes the working capital peg in the purchase agreement. If the closing balance falls below the peg, the price may be reduced. If it exceeds the peg, the seller may receive more. The analysis protects both parties from manipulating working capital before closing. Be sure to mention normalized working capital, seasonality, peg setting, cash conversion, excluded items, customer and supplier terms, and the purchase price adjustment. Explain why a misleading target level can transfer value between buyer and seller. Question 10. How would you assess risks in a transaction when information is incomplete? I would first separate known facts, assumptions, and genuine unknowns, then rank uncertainties by potential impact and probability. I would triangulate management information with customer data, contracts, industry benchmarks, public filings, and specialist input. For material gaps, I would use downside scenarios and sensitivity analysis rather than hiding uncertainty inside a single forecast. I would recommend mitigations such as further diligence, escrow, indemnities, earn-outs, price adjustments, or staged investment. Clear documentation helps decision-makers understand both confidence and exposure. Focus on identifying unknowns, prioritizing material risks, triangulating sources, documenting assumptions, running sensitivities, and proposing mitigations. Show judgment. Not every uncertainty requires stopping the deal, but material uncertainty must affect price or structure. Question 11. What is the difference between financial, commercial, operational, and technology due diligence? Financial diligence tests the reliability of earnings, cash flow, working capital, debt, and forecasts. Commercial diligence evaluates market size, competition, customers, pricing, and growth sustainability. Operational diligence examines processes, capacity, supply chains, people, and the ability to deliver the plan. Technology diligence assesses systems, architecture, cybersecurity, data, technical debt, and separation or integration complexity. These streams are interconnected. Weak systems may limit growth, while customer concentration or operational constraints can reduce the value of projected synergies. While answering, define each diligence stream and explain how they interact. Mention earnings and cash flow, market and customers, processes and capabilities, systems and cybersecurity, and the way findings influence valuation and integration. Question 12. How would you evaluate a company's competitive position during commercial due diligence? I would assess the market size, growth, profitability, structure, and key demand drivers before analyzing the company's position within it. I would examine market share, customer retention, win rates, pricing, product differentiation, switching costs, and barriers to entry. Customer interviews and cohort data would help validate management's narrative, while competitor research would test the durability of the advantage. I would then stress the forecast under weaker growth, pricing pressure, or share loss to determine whether the valuation remains supportable. Make sure to cover market growth, competitive landscape, customer needs, market share, pricing power, switching costs, barriers to entry, product differentiation, and management's forecast. Use both external evidence and customer-level analysis. Question 13. What makes a post-merger integration successful? Successful integration starts before signing with a clear deal thesis, operating model, governance structure, and day-one plan. I would prioritize business continuity, customer communication, key talent retention, systems access, legal entities, and decision rights. Integration teams need accountable owners, milestones, budgets, and a method for tracking synergies against the original case. The approach should reflect the transaction. A full merger requires deeper integration, while a capability acquisition may preserve autonomy. Culture and communication are as important as spreadsheets. In your answer, talk about integration planning before closing, governance, day one readiness, culture, communication, systems, talent retention, synergy owners, milestones, and performance tracking. Recognize that integration priorities depend on deal objectives. Question 14. How would you approach a carve-out transaction? I would first define exactly what belongs inside the perimeter, including entities, employees, contracts, assets, liabilities, customers, and intellectual property. Then I would build standalone financials and identify shared services, stranded costs, stranded revenue, and required transitional service agreements. Systems, data, tax, treasury, procurement, and regulatory dependencies need detailed separation plans. I would quantify one-time costs and ongoing standalone costs, test day one continuity, and ensure the purchase agreement clearly allocates unresolved obligations between buyer and seller. Be sure to mention perimeter definition, standalone financials, stranded costs, transitional service agreements, people, systems, legal entities, working capital, and day one continuity. Highlight the complexity of separating shared resources and operations. Question 15. How do financing and capital structure affect an acquisition recommendation? I would assess how the financing mix affects leverage, interest expense, cash flow, EPS, ownership, and financial flexibility. Debt can preserve equity ownership and enhance returns, but excessive leverage increases covenant, refinancing, and downside risk. Equity reduces balance sheet pressure but may dilute shareholders and signal valuation concerns. I would model base, downside, and severe cases, including interest rate changes and covenant headroom. The recommendation should balance funding cost with resilience, because a theoretically attractive deal is not viable if financing becomes stressed. Focus on debt capacity, interest cost, leverage, covenants, equity dilution, refinancing risk, flexibility, credit ratings, and returns. Explain that financing affects both transaction feasibility and the distribution of risk between shareholders and lenders. Question 16. What transaction risks would you consider beyond valuation? Beyond valuation, I would consider antitrust approval, regulatory licenses, litigation, tax exposures, cybersecurity, data privacy, compliance failures, employee retention, customer concentration, and cultural compatibility. I would also assess execution risk. The buyer may lack the systems, management bandwidth, or capabilities needed to capture the deal thesis. Each risk should be ranked by likelihood and impact, then addressed through diligence, purchase agreement protections, insurance, financing conditions, integration planning, or a revised price. This produces a more realistic risk-adjusted recommendation. In your answer, cover regulatory and antitrust issues, litigation, tax, cybersecurity, compliance, reputation, key person dependence, cultural conflict, integration failure, and execution risk. Explain how each risk can be mitigated through diligence, structure, or planning. Question 17. A client wants to acquire a competitor at a high premium. How would you advise them? I would not reject the premium automatically. I would determine whether the target's standalone value plus credible, buyer-specific synergies supports it. I would test revenue assumptions, cost savings, timing, integration costs, customer overlap, and competitor reactions, then compare the premium with precedent transactions and alternatives such as organic investment or a partnership. I would model downside cases and establish a maximum price or walk-away point. If the premium depends on uncertain synergies, I would consider contingent consideration or stronger contractual protections. While answering, focus on clarifying the strategic rationale, testing standalone and synergy value, benchmarking the premium, assessing alternatives, modeling downside cases, and identifying walk-away conditions. Show commercial judgment rather than accepting management's enthusiasm. Question 18. How would you structure an ambiguous M&A case interview? I would begin by clarifying the client's objective, decision deadline, transaction perimeter, and definition of success. I would then structure the case around strategic rationale, market attractiveness, target economics, valuation, synergies, risks, and implementation. I would state assumptions explicitly, prioritize the analyses most likely to change the answer, and communicate interim conclusions. After calculating the key outputs, I would recommend a course of action, quantify the rationale, identify the largest risks, and explain the next diligence steps rather than forcing false precision. Make sure to cover clarifying the objective, setting a framework, identifying key facts, prioritizing analyses, stating assumptions, calculating carefully, and synthesizing a recommendation. Demonstrate communication and hypothesis-driven problem-solving. Question 19. Tell me about a time you used data to influence an important recommendation. In a project, I analyzed customer-level revenue and found that overall growth was masking declining retention among smaller accounts. I segmented customers by tenure, product, and geography, then built a cohort analysis showing where the deterioration began. I presented the finding with a simple dashboard and recommended targeted onboarding rather than broad discounting. The team adopted the approach, improving follow-up discipline and giving management a clearer forecast. The experience taught me that analysis matters most when it changes a decision and is communicated simply. In your answer, use a concise situation task-action-result structure. Explain the data source, analytical method, insight, stakeholder challenge, recommendation, and measurable outcome. Emphasize judgment, communication, and business impact rather than technical detail alone. Question 20. How do you ensure accuracy and quality when working under transaction deadlines? I work quickly by creating structure before modeling. I define the objective, source every key input, separate assumptions from calculations, and use consistent naming and checks. I reconcile totals, review formulas, test sensitivities, and maintain version control so changes are traceable. Under pressure, I prioritize decision-critical outputs and escalate ambiguous or material issues early rather than concealing them. Before delivery, I perform a reviewer-style pass, checking logic, units, formatting, and whether the conclusion actually follows from the analysis. Be sure to mention organized work papers, source checks, formula discipline, review procedures, version control, prioritization, escalation, and clear communication. Show that speed matters, but so do transparency and professional skepticism. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.